What's up, everyone? Welcome to Trifecta. This channel is where I'm documenting my real journey toward building a long-term wealth using three pillars. First is a fully funded emergency fund paired with strict budgeting. Second, a brokerage account designed to eventually cash flow my bills through dividends and distributions. And third, a tax-efficient retirement accounts built for long-term compounding. I'm not a financial expert. I'm not rich. I'm just a regular guy who grew up in a low-income household, didn't get much financial education, and spent most of my adult life trying to make progress without ever seeing a real breakthrough. I'm here to change that, God willing. And if you're watching this thinking, if he can do this, maybe I can too, that's the whole point. Because this isn't just about money, it's about building tools that can help us, our families, and our communities. Today, we're looking at how SPYG fits into my cash flow brokerage account. But first, let's zoom out. Like most things at Trifecta, it's built around three distinct roles, not just chasing yields. First is growth holdings to protect purchasing power and grow the base. Second is income holdings to generate consistent cash flow that I can use now to pay bills. And third, higher yield holdings to accelerate income while accepting higher risk. These also will be used to pay bills. Here's how that looks in my portfolio right now. Growth-focused ETFs and funds, which are SPYG, CRF, and CLM. SPYG is pure equity growth, while CRF and CLM are leveraged closed-end funds that combine growth exposure with income. Second is income-focused ETFs. That's QQQI, BTCI, and ECAT. And last is the higher yield ETFs, WPAY, QQQY, YBTC, NVDY, and YMAX. Based on current distributions and my portfolio weightings, this produces a blended forward yield of roughly 25%. That yield is not guaranteed, can change over time, and reflects very different risk profiles, which I'll break down individually in future videos. I'll be reviewing each holding in order of allocation, explaining exactly why it earns its place. Today, we start with SPYG. Let's dive in. SPYG plays a very specific role in my portfolio. This is not a dividend ETF. This is not an income ETF. SPYG is here for growth. Its job is to grow the capital base over time, help offset inflation, support long-term sustainability while income is being pulled elsewhere. Think of SPYG as the workhorse of the portfolio. It's not flashy, but it keeps the machine running. That's SPYG. Not exciting, just essential. If you want to do your own research, if you just Google SPYG State Street, that's who manages this fund, and then search SPYG, it will pull up all the different information about this ETF, the current NAV price, the gross expense ratio. What I want to look at here today is the holdings. SPYG tracks the S&P 500 Growth Index, holding large U.S. companies expected to grow earnings faster than the broader market. Businesses with strong balance sheets, durable cash flow, and long-term growth runways. Its dividend yield, as we saw before, is relatively low, and that's intentional. The income in this portfolio comes from other positions. SPYG's value comes from price appreciation, not monthly cash flow. Here's why that matters. As income producing assets distribute cash, capital can slowly erode without a growth engine behind them. SPYG helps replenish and expand the portfolio so future income has a large base to work from. In simple terms, high yield positions provide the cash. SPYG helps make sure the portfolio doesn't shrink over time. So if you want to see what all the holdings are, just click on this daily holdings here. SPYG makes up 20% of my portfolio. It acts as a stabilizer and growth driver inside a higher yield strategy, helping balance volatility, support reinvestment, and give me options through rebalancing or future income deployment. SPYG also gives me exposure to many of today's strongest growth companies, including names from the Magnificent Seven and others I believe in long term. The Magnificent Seven is like the Nvidia, Microsoft, Apple, Google, Broadcom, Meta, which is Facebook, Amazon, Tesla. One company I'm especially interested in is IBM. You can see them down here. Where'd they go? International Business Machine. I believe it has meaningful upside as a quantum computing player over the long run. And because SPYG is rules based and index managed, companies that lose their growth characteristics are replaced over time, giving me diversification without needing to research individual stocks. The real question becomes simple. Do I believe the best growth companies in the US will continue to grow? For me, the answer is yes. I'm not expecting SPYG to pay my bills today. I'm expecting it to help me make that possible long term. SPYG will underperform environments where value stocks outperform growth, interest rates rise sharply, investors favor income over expansion. That's a trade off I'm comfortable with because SPYG isn't here to maximize yield, it's here to protect the engine that makes the cash flow sustainable. As you can see here, it had a huge dip around April. Um, that was when the big tariff scare was. But as long as you stayed invested, you were able to make your money back and then some. What I really like about the system that we're doing is, or that I'm doing, is I'm dollar cost averaging. So let's say in this example, I was buying here, and then every week I'm putting in $120. And it's not all going to SPYG, but a portion, 20% of it is. I just every week just keep buying, just keep buying. So I would be buying really cheap here, and then not so cheap here. But as you can see, it just you're buying high and you're buying low. At the end of the day, money is just a tool, something that we can use to love God and love others. If this sounds interesting, hit subscribe, drop a comment, and let me know. Does the trifecta make sense, or where does it break? I'll see you in the next one, and remember, help someone smile and learn something new.